Michael Arone is chief investment strategist at State Street Global Advisors. They've got over $3 trillion in assets under management. Tim Seymour is here with us as well. Michael, what do you say about the market? Stick with it?
I do think you stick with it. Kelly, we were caught in a range. That ceiling was 4,200. And I think we needed three things to break that ceiling. We got one of them last week, and that was the debt ceiling resolution. I think next week we're going to get more clarity on the future path of monetary policy. And I think if we do get that pause, I think markets will respond favorably to that. And the third is this kind of notion of the timing and the depth of the recession. But this week, it seems like investors believe that a softish landing is possible. And I think those have allowed us to break that 4,300 level and hit highs in the S&P for the year.
And new highs in the S&P for the year. Do you worry at all about the macro, Michael?
I certainly do worry about the macro, but I've been saying since August that the economy isn't the market and vice versa. So if we think about it, last year the economy expanded, earnings grew, and the labor market was the best in 54 years. Yet we had the first dual bear market in stocks and bonds in history, and the 60-40 portfolio was terrible. This year, all those things are going to get worse, yet stocks and bonds are rallying. So I think investors are already looking ahead and pricing in that this will probably be a mild recession if we get one at all, and ultimately that earnings will rebound in the second half of 2024. And I think that, I may have a little bit of rose-colored glasses on here, but I think that they're going to price in a recovery far before the economy, earnings, and the labor market follow.
And earnings recovery in the second half of 2024 is a long way away, but you do not think it is too early to start beginning to buy the kinds of equities that benefit from early stage recovery, and what are they?
So timing is always such a challenge, as we know. But here's the thing. I would prefer to be buying those parts of the market that are trading at 10 and 11 times forward earnings. So again, if we want to just do a simple earnings yield, with the S&P being brought up by those 5 large companies at 19 times, has an earnings yield about 5%. Well, I could buy a money market instrument for 5%, but a lot of small caps are trading at 5 and 6 times earnings. So their earnings yield's much bigger. So I like value stocks, small cap stocks, cyclicals, and if we want to get real specific, things like Deere, Caterpillar. So if you like industrials, for example, I think that's a great place to be in this marketplace.
Tim, how does this strike you?
Well, the things that worry me are more right now positioning and where we are and where we've come from. The complacency that seems to be in the market as evidenced by the VIX. I believe in mean reversions. I believe that when people were so on one side of the boat in terms of either, you look at those bull bear AI indices, you look at the name index, so active managers, we're basically at a 15-year average here. People are not underweight necessarily. You had these record kind of shorts in E-minis, and there's some misinformation on that too. I think positioning right now says, despite the technicals taking us higher, that maybe it's going to be harder to make that next move. Having said that, I think we're going to see 400 on the Qs. I think we're going to see 160 on the SMH, which are basically getting to those old highs. And I think we've made relative highs in the leaders. I think we're going there. And I think back to small caps, if you think about if we're in a bull market, you tend to see that growth leads value. And so small caps have really underperformed. In fact, it was SVB that knocked them down 22%, and they're just kind of catching up. So I think, if you're looking at small caps and just playing the IWM, I think there's a little room to run here. The macro and where we are in the economy and the leading indicators, we've all chronicled this. It's not rosy. But this is one of the greatest trading markets we've ever had. We've had 3 moves this year alone of either, we went up about 14, we went down about 9.5, we're up about 12.35 from the SVB low. So as someone that's been in emerging markets my whole career, they
feels
often,
like one?
It feels a little bit like one. They often track each other. So you tend to hedge the EM with the IWM, and we're actually seeing both of them start to break out here. High correlation.
All right.
Fascinating.
Gentlemen, thank you very much. Michael, we appreciate your time today.